You also have the potential for a bursting of the AI bubble, which could be disinflationary as well. And from that
Or
standpoint,
downright deflationary, right?
right. I mean, yeah, if all of this spending reverses and you get a real kind of deflationary impulse in the economy, it could easily probably counteract the inflationary forces in the economy. So it's like I said, so many cross currents and very precarious time.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Wall Street's partying hard right now with stocks at all-time highs. Unless a significant correction happens soon, the S&P will put in its third year of double-digit returns in a row. But pressures are building. The AI juggernaut, which is driving so much of the US economy and the market's rise these days, increasingly appears to be in bubble territory. While on the other hand, a large percentage of American consumers are increasingly struggling under the high cost of living. How will these pressures resolve in 2026? Well, to discuss, we welcome back to the program macro analyst Jesse Felder, founder and editor of the respected market research firm, the Felder Report. Jesse, thanks so much for joining us today.
Always good to be with you, Adam. Thanks for having me back.
Thanks. Oh, it's a pleasure to have you back, Jesse. Lots to talk about. Lots happened since the last time you've been on the program here. I've got a bunch of questions based off of some of your recent posts there at the Felder Report, but I haven't asked this question for a while, so you're a good guy to ask it to. It's my general kicking off question, but I'd love to get kind of a high level sense of how you're seeing the world right now. So what's your current assessment of the economy and the financial markets?
Yeah, I mean, it's a great question. I think that there's so many cross currents right now. It feels like more than there are always a number of them, but I think right now it feels like it's a especially tricky time. We have inflation reaccelerating, and at the same time unemployment rising. So I think the economic environment is getting increasingly stagflationary, with a weakening labor market and rising price pressures that are partly due to the tariffs, but also I think more probably to do with underlying macro factors such as demographics and deglobalization and these types of things that I think we've probably talked about every time you've had me on the program. So we're getting increasingly stagflationary, but at the same time, the economy, GDP figures are holding up well, largely due to the AI bubble. So, the massive spending in CapEx going into data centers and all these things is now responsible for a huge percentage of the economic growth, which is kind of holding up the economy right now. And so I think you have, it's a pretty precarious time. If you think inflation pressures are rising at the same time that unemployment is potentially going to continue to worsen, and everything comes back to being dependent on this massive AI bubble holding the economy up. I think it's you could argue it's one of the most precarious times for the economy that we've seen in a long time.
All right, so let me ask you this. You said rising inflation, but rising unemployment. At what point does rising unemployment become disinflationary? Right, where just more and more people can't afford to pay these prices, so they start constricting their spending.
I mean, that's a good question. That's right. I don't. That's way above my pay grade. Honestly, I'm not an economist, but you're absolutely right. If one of the inflationary factors in the economy is this is demographics, the fact that the share of the population that is among the workforce has been shrinking, putting more pressure on fewer workers to deliver the same amount of economic production. Then to the extent that the unemployment rate rises and kind of loosens those pressures, that could help. You also have the potential for a bursting of the AI bubble, which could be disinflationary as well. And from that
standpoint, downright deflationary, right?
Right. I mean, if all of this spending reverses and you get a real kind of deflationary impulse in the economy, it could easily probably counteract the inflationary forces in the economy. So it's like I said, so many cross currents and very precarious time.
All right. Well, we're going to talk about a lot of these in more detail. But let me ask you this. Here you're talking, and there's a thought in my mind that so much of the economy is being driven by the AI CapEx build out right now, right? And yes, GDP is a measurement of spending. So if money's getting spent, it's contributing to GDP, right? And investing in infrastructure, there are a lot worse things to invest in, right? I mean, you're hopefully doing a build out that's going to be generating future incremental value. But right now, what's driving the economy right now in terms of GDP growth, really just money coming off of corporate balance sheets. So in other words, it's not necessarily sort of like organic value production. It's like a big bet, right?
Yeah.
We're like dipping into savings to say, okay, I'm gonna spend on X, and I'm gonna hope we're gonna get more than X going forward. But right now, it's kind of a grand, I don't call it a gamble. It's not like this is necessarily an unwise thing to do. But we're spending truckloads of money that are coming out of corporate balance sheets, and we really don't yet know what we're going to get from it.
Yeah, I think what's fascinating to me about this is all of the talk of a bubble, right? It seems like every financial media outlet is calling it a bubble. You have Sam Altman
The
coming out.
Titans themselves, like Sam Altman, are
Exactly.
calling it a
Sam
bubble.
Altman coming out and saying, yeah, this is probably a bubble. Mark Zuckerberg, Jeff Bezos was the latest to call it a bubble. And so, it was interesting to hear Mark Zuckerberg even walk through how does a bubble work in infrastructure like this, whether it's the railroads or the dot-coms. You see a massive overbuilding of the capex that leads to a crash. Because demand for that infrastructure just takes years to materialize, even though we overbuild in the short run. In the long term, it's a good thing for the economy. Just like the internet, having all of that dark fiber that was overbuilt in 99, 2000 ended up being a great thing for the internet going forward, because it was very, very cheap to light it up when the time came, when the demand actually materialized. And same thing for railroads and everything. I think that's, it's fascinating, like I said, to hear Zuckerberg talk about this, because he said, yeah, if we overspend by a couple $100 billion, so be it. Well, it sounds like that's kind of what they're planning on. They know this is how this works, is that we're going to overbuild and we're going to have a bust, because the demand isn't there for AI. And down the road, this will be beneficial to the economy as we, create more and more productive AI services, which just really haven't arrived yet. I mean, the AI revenue is, in the tens of billions of dollars, and we're pushing trillions in terms of spending on the build out. So the revenue is not there to back it up. I think it's pretty clear to everybody involved that there will be there already is an overbuild. And as you mentioned, I think it's a really good point. A lot of this has come out of corporate free cash flow, right? In the very beginning, it was Microsoft, we're going to use some of our free cash flow. Alphabet, and all these companies have been very asset light and good cash flow producers. Now they're completely shifting, where they're spending so much cash into capital intensive uses. They're changing their business models. At the same time, as a group, they've all run out of cash. There is no more cash left on the balance sheets of the Magnificent Seven. And so what do we start to see? We start to see the money coming out of private equity, private capital, are starting to realize, okay, for this to keep going, we're going to need, Meta's going to have to rely on Blue Owl and Apollo and these big firms that have too much money burning their holes in. So we're now into the debt part of this cycle.
Sorry to interrupt, but just I'm chuckling because, and then there was the recent executive order that said, hey, let's enable retirement funds to start investing in alternative assets like private equity and private credit.
Yeah.
Did that happen in a vacuum, or is that tied to what you're talking about? I think it's probably the latter.
Yeah, absolutely. And a lot of these companies have had, in terms of private equity, they haven't had the cash outs, that they've been looking for, and so they need to find that. But I think it's very telling that we're into the part of the cycle where Meta doesn't want the further capex on their balance sheet. So we're going to create these special purpose vehicles. We're going to use funding from private credit to fund it. And so we're now kind of, not only having kind of echoes of the dot-com bubble, we've got some echoes of the housing bubble and the great financial crisis. We're using off-balance sheet financing to, and special purpose vehicles to get a lot of these deals done. And I think that's all kind of, not to mention the vendor financing and circular finance stuff that, it's, to me, it's very clear that this is kind of late cycle stuff in terms of this CapEx build out.
So this begs a question, and while you're answering it, I'm going to try to pull up a article that I saw yesterday, which basically sort of quantified how much of the like NVIDIA's revenues are coming from circular recycled flows, and it was staggeringly big. I knew it was going on, but I did not realize how big of a percentage of its revenues was. So I'll try to bring it up so we can comment on it. But let me get to the punchline then. I was going to work my way to this in the discussion, but let me just bring it up right here. Okay, so if we're in a bubble, and everybody knows we're in a bubble, and perhaps we're in a bubble because that's just what's called for at this moment in economic history. We need a big build out. It's got to be financed. There's a ton of long-term money that's going to be made, but to make it, we have to get all this infrastructure built out, and we just know that we're going to overbuild initially. It's almost as if I told you at the beginning of the South Sea bubble, Jesse, how it was going to end. I just couldn't give you the timing. Right? I could tell you, Jesse, this is going to go up by, X many zillions of multiples from the first share price. It's all going to come crashing down at some point, but you know that mania is ahead of you. How do you play this as an investor?
Yeah, it's a great question. I think that it's extremely difficult to try and play it on the long side. I think, Paul Tudor Jones was just talking about this today, that it's very clear that we're in a blow off phase. It feels a lot like 1999. You don't know when it turns. And I think he used the term, you need to have really happy feet. If you're long this market, you need to be ready to get out quickly. And I think a lot of people point out to like to say that, well, so many people are calling it a bubble. Too many people are worried about it reversing. That's not what the top of the market looks like. I would say if you understand bubbles and you really research them, and I don't know, a lot of people who have done more research than Robert Shiller. You read his book, Narrative Economics, and he talks about these tipping points in these narratives and how when you get these episodes where history clearly rhymes with a previous period, it actually makes the market more vulnerable because everybody knows how this thing reverses. So as soon as stock prices start to reflect that, okay, maybe we're out of the blow off phase and now into the bust phase, everybody's going to try and get out at the same time because everybody knows how this thing ends. And so it's a very, like I said, it's not just very precarious for the economy, it's very precarious in the market right now. And Schiller actually wrote a piece for the New York Times a few years ago, not too long ago, 2-3 years ago, where he suggested that the risk of a crash was elevated during these times when everybody kind of was starting to come around to see the same narrative. So I think it's probably more relevant today that everyone is talking about a bubble that actually makes the market more vulnerable to a bursting, a crash type of episode in the market when everybody kind of embraces that bubble narrative at the same time.
Okay, so you earlier mentioned, some signs you're seeing that are sort of classic of late stage. So again, kind of getting down to brass tacks, from an investor standpoint right now, what do you think is prudent? Is it hey, let me get out of the pool and leave stuff on the table? Is it to just work on having really happy feet and I'm still dancing, but I'm like right next to the door? Is it using hedges? Is it shorting? Is it what are, I'm guessing
there's a lot of that.
Stage.
It's a great question. There's a lot of that Chuck Prince talk, the music's still playing. So
and I hate to mention it because it ended out really poorly for Chuck. Yeah.
Right. I mean, but there's a lot of that kind of talk right now. Well, markets are still going up, they're still responding to these open AI deals with AMD going up 30% in a day. And so music's still playing. We're still, but when you hear that kind of talk, yeah, it is absolutely reminiscent of the Chuck Prince quote that was literally at the top of the dot-com bubble before the market rolled over into very painful. episode. I would just say there are actually several indicators that I'm watching right now that make me concerned right now for a potential reversal. One of those, as I mentioned, we're entering into the credit stage of this episode, this capex boom, where the companies are turning to private capital to fund a lot of this. Well, go look at the stock prices of KKR, Apollo, Ares. These big private managers' stock prices are tanking right now. Why are they tanking? Well, we've had two large bankruptcies, over the last couple of weeks in Tricolor, which was a used car retailer and lender, and in First Brands, which was a auto parts company. Both were massively over-leveraged and took on more debt than any of their creditors understood, probably 2 to 3 times more debt. And this is the problem, that Jim Chanos was recently talking about with private capital, is there's so many different layers of debt that, it's actually hard to understand how much debt a company has taken on. My point is that if we're starting to see a turn in the credit cycle, and that's literally what these stock prices are saying to me right now, then it's going to be increasingly difficult for these big capex plays to continue to turn to Apollo and KKR, Blue Owl, et cetera, for tens of billions of dollars that they're going to need, hundreds of billions of dollars that they're going to need to build out if the credit cycle is turning and these guys are going to start to come under greater pressure. So that's something I think that people aren't paying attention to. Another thing I would say is those guys, those founders at those firms have been some of the largest insider sellers that we've seen over the last 2 years at a time when insider selling is hitting all-time records, not just in terms of dollars, but the sell to buy ratio over the last 2 years, 24-month sell to buy ratio is the highest in my data set. A lot of that is Mark Rowan and these guys, these big private equity guys founded these firms, are cashing out hundreds of millions of dollars. They're usually good timers of their shares. So that's another sign to me that credit cycle may be turning. But the bigger message from the insider activity is that insiders are really good timers in aggregate as well. So when you have these massive periods of insider selling, it's a really good sign that economic activity and earnings are going to disappoint in the quarters ahead. So it was literally the start of 24. Almost 2 years ago that we really saw this big spike in insider selling. That has about a 2-year lead on the economy and earnings. So literally that we're coming up to that period right now where the insider activity is forecast a downturn, a steep downturn in earnings. That could happen this quarter, next quarter, potentially in the first quarter. But insiders are telling you the economy is going to turn, and so, and then the final thing I would say is, as the markets keep going up, we're seeing a very interesting anomaly in the market where market goes up, S&P goes up, volatility, VIX volatility index goes up, right? Actually, last week, the S&P 500 was up 1% and the VIX was up 8% in the same week. This is very rare. Typically, right, volatility comes down when stock prices go up. There's only been 2 weeks, two other weeks in the last 30 years where we've seen S&P 500 up 1%, VIX up 8%. Both of those were in late 2017 and the lead up to Volmageddon, before those short VIX ETFs blew up. So I think that points to there's something under the surface in the markets. It could be the dispersion trade. A lot of institutional investors have been, essentially selling index volatility and buying single stock volatility. It could be the fact that, the options investors are just getting a little bit more nervous than equity investors. I don't know. But the options market is telling us that there could be another volatility event in the near future, at the same time as you see the big private equity guys' stock prices starting to tank. And the timing of this insider selling is really going to come to head very soon. So I'm starting to see these types of signals that say, hey, it's time to really, if you're in the market, you better have super happy feet, like Paul Tudor Jones said, because once this thing reverses, it could get nasty very quick.
Okay, whole bunch to respond to there. I'm glad you brought up insider selling, because I was going to ask you about that, because you've mentioned that many times in our recent or interviews over the past couple of years. But I think it's important to understate what you said there, if I heard you right, which is it tends to sort of have a 2-year lag to it. And so you've been seeing, over the past 2 years as we've been talking, the pickup in insider sales. And you're now saying we're kind of now entering that time period where the lag is now behind us and we should start seeing the actual manifestation of this. I think
Yeah.
if I remember correctly, did you say that was like your, there's no one perfect indicator, but if you were going to be
Yeah, if I had
exiled
only
to
had one, it would be that. Because in aggregate, if you think about it, the leadership of the Fortune 500 companies, they have their finger on the pulse in aggregate, their finger on the pulse of the economy. They can see better than anybody else what's going on with their underlying businesses, how people potentially overpromised and are going to potentially underperform in the quarters ahead, and how the stock prices what discount that or not. And I think it's very clear right now that insiders are saying stock prices do not discount what's likely coming in the next 6 to 12 months. And as I mentioned, actually one of the charts that I highlighted recently to my subscribers is how the insider sell to buy ratio leads the ISM composite. And the ISM composite has just started to roll over, and right in the timing that the insiders said it should about 18 months ago. So yeah, and ISM composite is a good leading indicator for corporate earnings. So a lot of this is pointing to analysts are forecasting record earnings, record profit margins in the quarters ahead, and I think insiders are telling a very different story. And I'd also just highlight too, something I haven't spent a lot of time on writing about, but when I looked at it recently, I said, what's going on with these big private capital firms? Why are the stock prices getting hammered? You see, as I mentioned, the rapid and surprising bankruptcies of First Brands and Tricolor. That's kind of sent some shockwaves through the markets that maybe there's been too much money chasing too few deals, and really committing too much capital into into bad deals. And when you look at it, as I said, these guys have been some of the biggest insider sellers that we've seen over the past couple of years, and historically they're good timers, right? So a couple of these guys have sold $500 million this year it was the first insider sales since 2021. So these guys know how the cycle works, and they're really good, obviously financial experts. And even more than the Fortune 500, right? They're lending money and giving, and investing equity into, a lot of smaller businesses, private companies, obviously across America. And sitting on the boards of those companies, again, they see what's going on in the economy, and they know, better than most, how things are trending.
So it makes total sense. And I also wanted to hear, Jesse, one of the things that I've explored in previous interviews with folks is the fact that, private credit has really exploded in terms of a funding source for corporate America. And that is not regulated the way that the banking system is, right? And so the question it raises is what are the quality of these loans, right? I mean, we don't know. And is this setting up the potential for a surprise to the general system, where it's like, oh my God, sort of like this to the subprime industry. It's just like, whoa, wait a minute. We didn't really have transparency into there. We assumed that they were lending rationally, but man, it looks like they gave a lot more loans that they shouldn't have. And now this is becoming a systemic issue, because it's not necessarily just those companies' balance sheets, right? I mean, aren't the banks somewhat, even though the banks are regulated, I believe they also have some exposure to the private credit world, because in a lot of cases, they're lending to those companies to then lend.
Yeah, I think JP Morgan was a big lender to Tricolor. So there's a lot of it, going on where these companies, take money from the banks and then take money from private capital on top of it. And, they do that through, separate LLCs and things that aren't on the surface maybe affiliated with the company, but clearly are going to finance inventory or, whatever they're doing. And there's been no fraud proven at these two companies, but the fact that they imploded in such short time and nobody really understood how much debt they were taking on suggests that there potentially could be. And as Jim Chambliss has said, they're probably just the tip of the iceberg here. There's probably been tons of this kind of stuff going on. And I think, like I said, that explains why the stock prices of these guys is starting to roll over really hard, even as the market goes straight up.
Yeah. It's last point I'll just say on this is, I've said for a long time, I think the easiest headline to predict is, oh my goodness, all these buy now, pay later loans are going belly up, and whoever could have foreseen this, right? But I think private credit is not too far away from that. I mean, there's plenty of great loans being made in the private credit space. So I'm painting with a really broad brush here, but I think when you have a large, fast-growing and opaque lending environment, rarely does that work out great in the long run.
Yeah, and I would just point out too, there's been a lot of coverage over the last couple of years about the growth in payment in kind lending, PIK loans, which is a lot of these companies who've taken on debt from private capital are not able to make the interest payments on their debt. And so rather than default them, this is one of the reasons why defaults have been so low in the credit markets. Rather than default them, it's in the interest of these private credit companies to say, well, why don't you just add the interest to your debt balance, every month, and we'll just call that payment in kind. You're paying us in more debt. Mm-hmm. So that's, imagine, if like you never even paid the minimum payment on your credit card, and you just let it, grow exponentially until at some point in the future you're going to be able to pay it off. Well, there's been so much PIK loans going on right now, for so long, that I think that's also a potential problem too. That at some point they'll be able to have to recognize, okay, these are not going to get paid back. We're going to have to default these guys.
Oh yeah, it's just crazy. I mean, think about the malincentive that gives the consumer. Yeah, I just won't pay. I'll build up this massive balloon balance, and then I'll just declare bankruptcy. And the guy's just going to have to eat it, right?
Yeah, and because I'm not in default, I can actually go borrow from somebody else in an off-balance sheet arrangement. Like it's madness.
It is madness. Okay, look. Okay, so I do want to talk some more about how this could all end up, but again, in the spirit of pulling things I usually have in the end of the interview to hear. So very precarious time. If you're going to be long, have happy feet. So how does one invest in this market environment? I know you've had a series of things that you're interested in, and I'd be curious to hear they tie into this, like commodities and whatnot. But what are you looking at right now in terms of an investing approach?
Yeah, I mean, I think one of the big questions I've been asking myself is what is gold telling us, right? Gold price has been going exponentially higher. And some of that is people just getting more enthusiastic about owning it. Some of that is probably a message as to the creditworthiness of major sovereign governments and their ability to pay back debt in dollars that aren't debased. But I think some of it too is gold is a really good leading indicator of the broader commodities space. And it leads by about, I don't know, a year to 2 years. And so if you just overlay, like the Bloomberg Commodity Spot Index over gold lagged a year or two, gold does a really good job of telling you where the broader commodities markets are going. So I think gold is saying, the biggest message that gold is saying right now is that inflation is here to stay. Inflation is going to continue to rise. We're 4.5 years already above the Fed's target, and it's not going back to target anytime soon. And the next leg of this is likely going to be the broader commodities space catching up with gold. I've been surprised with actually copper strength recently, but the whole broader space. One of the things that I look at, that Gehring and Rosenzweig has pointed out is a great way to value commodities. It's just value them relative to each other. Well, outside of the 2020 low in the oil price when it went negative, oil is cheaper relative to gold than it's ever been in history. Oil is extremely cheap. I think that you could say that about the broader commodity space too. So I think gold is telling you that it's already discounting an increasingly stagflation environment, like I said at the outset. How you play that is, I think gold's already discounted that trade. The rest of the commodity space has not.
Mm-hmm.
So I think there's a real opportunity in the broader commodity space to own something that's, but essentially historically been the best way to protect yourself from inflation. It's through owning energy shares and other commodity, producers and the commodities themselves. And so I think that, that's one way, is make sure you're diversified into other asset classes, namely real assets, and gold has obviously been the main one that's worked really well, but the rest are still I think great viable things, even including tips, inflation protected securities. So, but I think right now there's a real opportunity in commodities specifically.
Okay, and it sounds like, I mean, this is sort of good news, right? You're maybe nervous about stagflation continuing from here, and maybe you missed gold's rise. You didn't listen to a lot of the folks on this channel, including you, over the past years. But hey, it's not too late. There's a train that looks likely to leave the station and maybe build up speed pretty quickly because it's trying to catch up to gold, and that is the greater commodity complex. I was going to ask you about oil, so I'm glad you went there. Given the opportunity in the precious metals and specifically in silver, which had been lagging gold, when silver got to $35 an ounce on X, I don't know if you saw, Jesse, but I gave myself silver eyes, the way that the Bitcoiners have given themselves, laser eyes.
Nice.
Yeah. And I was sort of asking around, like, anybody else, gonna do, interested in doing this? And fortunately, I don't always time things well, but I mean, silver futures are knocking on $49 an ounce the day we're talking here. So it really moved in the way that I had expected it to. And somebody else recently asked me, well, so what's next? And I'm thinking, maybe it's time to give myself oil eyes pretty soon, given how undervalued that seems and the potential opportunity that you're talking about.
Yeah, I think that's a great place to look. I think if you look back 2-3 years ago, it was really hard to be a gold bull, right? You had Fed raising interest rates, and we thought, oh, you can't fight the Fed. When Fed's raising interest rates, you can't own gold. And gold disconnected from the real interest rate models. Everybody thought, oh, gold's going to have to go back down to 1,000 an ounce. But it was really hard to be bullish, and that was actually a really good sign that it was a great time to be bullish on the precious metals. Nobody wanted to own them. They were left for dead, despite the fact that it's very clear today that the fiscal situation in all of these major developed economies is continuing to deteriorate, and you're seeing this play out in the long-term bond market. Look at 30-year yields in Japan hitting record highs. In the U.S., we're kind of just off the highs, but Germany, France, we're UK especially, we're seeing the bond markets continue to send signals that, okay, we're worried about committing 30 years to some of these governments, and because of their ability to kind of get their financial house in order. That was the bull case for gold 2 years ago, and it's played out, and people are jumping on that narrative. I think oil is where gold was 2-3 years ago today, where the fundamentals are changing in very, very bullish way. I don't think people appreciate the fact how much all of the major frackers have high graded their production. All we're gonna run is our most efficient wells, and we're gonna basically run them dry. We're not drilling. You look at drilled but uncompleted wells, have dried up, and U.S. oil production is potentially going to peak and roll over right now. And so at the same time, demand continues to grow. We keep hitting record highs in terms of demand.
Right. World is still runs on oil as much as many people would love for that not to be the case.
And the way that oil goes is in these big cycles where you have a new producer that comes on and creates a big oil glut. Market goes into a long-term bear market, and then that producer, the growth, their growth, stagnates or starts to fall off and actually peak and reverse, and then you set the stage for the next big bull market. So this last big bear market was created by the growth in fracking, right?
Right, the shale miracle, yeah.
This huge new growth in supply came on market. We had oil price crash in 2014, 15, 16, go negative in 2020. And now what's happening to this, to the single greatest source of oil production growth over the last 10, 15 years? Well, it's potentially peaking. We're potentially, past peak production in the US here. And
right.
we're saying,
or at least at these prices, but yeah.
No, in terms of the Permian is really where all the rest of the growth is. And it's potentially, reach its max production levels, because the future growth in the Permian is going to come from less productive wells. Mm-hmm. All of the good wells, and this is what we've seen with every other area, of shale, production is the good wells run dry, and then it becomes much, much harder to extract the same amount of oil out of the same number of wells. And so the productivity of those wells declines. We're at that point now in terms of the Permian, which is the last area of growth in the US. So you're seeing this, this major change in terms of production, where the single greatest source of oil production is, entering into kind of its later stages. At the same time, demand growth continues to grow. And I'd even point out too that, a lot of the estimates for oil demand were based on the mass adoption of electric vehicles and these types of things. And now we're seeing a huge decline in the adoption of electric vehicles. And that's not being reflected in demand for oil yet. And it will be. And so I think right now the future fundamentals for oil are getting more and more bullish every day. And investors have literally never been more bearish. You look at the Commitment of Traders report, managed money has its lowest net long position on record. People have never been more bearish on the oil price today. And the fundamentals just keep setting up longer term, more and more bullish.
So given that, Jesse, how are you looking at playing it? Is it the largest oil producers, like you got great brands that are trading at a discount? Is it the commodity itself? Is it the midstream companies? What's most interesting to you right now?
Yeah, I actually owned a lot of the midstream infrastructure companies, pipeline companies. I owned for the last 5 years. I'm a lot more interested in the producers today. And where we've seen the most interesting insider buying over the last few months is actually in the offshore equipment companies, which is interesting to me. The big offshore companies, Transocean and Noble Energy and a couple others. It's actually been interesting insider buying in the entire group in the offshore sector. So I haven't had much interest in the services companies until the last few months, when I saw that kind of big buying among the offshore companies. But I think generally the producers are attractive. You can buy Occidental Petroleum today at a cost basis that's below Buffett's. Right? And most people, what's Warren buying? I want to know what Warren's buying. Well, you can buy Oxy below his cost basis today. Nobody wants to own it. That's another sentiment signal for you. So I'm interested in the offshore services companies and generally the producers like Occidental.
All right. Super interesting. And I sense we'll be talking a lot about this going forward. Let me ask you another question about energy. So this is less oil related, but even if there's an AI bust, it seems like that could really crater market prices. But it seems like the winning the AI race is a top strategic imperative at the sovereign level, right? Okay. So it's sort of come hell or high water, the US is going to do whatever it takes for the US to have the best AI out there in the world. And that race, as I understand it, is largely going to be won, yes, on software, but also on access to plentiful, cheap energy, and specifically electrons. I'm sure you've seen the same charts I have, Jesse, about comparing China's electrical production capacity and its growth compared to the US. And the US is just flatlined and left in the dust, while China is almost like a vertical line, right?
Yeah.
So we've got religion around this. Hopefully we're going to start closing that gap. But that just means just gargantuan build outs in rebuilding our energy grid, our electrical grid. What's the scope of that opportunity? And
I
where
mean,
do
it's
where do you
demand for natural gas, right? I mean, when you look at how are we going to meet this demand for AI, it could potentially come from nuclear, right? I mean, but
right? But
nuclear
it's going to
takes
take a long time under the best case of scenarios.
exactly. Nuclear takes a long time to come online. You can bring on natural gas plants much faster. In fact, there's one company that I was studying recently. I can't remember the name. I think it was New Fortress Energy, and they were building kind of these almost temporary natural gas fired plants that they could get up and running in just a few months' time. And they were going to start pitching this. They were already doing this in kind of for like island nations and things, because they're also transporting natural gas liquids.
Mhm.
But they were going to start pitching this idea to the data center companies. We'll build you a power plant
Right.
in
Set up your
months,
own power plant. Yeah.
right next to your data center. And so yeah, I think right, because green energy is not an option for a lot of these companies. It's not reliable enough. They can't rely on wind or solar. I think a lot of these actually big power companies have said, hey, look, one way we can get approval from the public to allow you to purchase up all this electricity demand is if we flex it. And we say, okay, when demand gets too high, we're going to cut off power to the data center, right? And and that's the way we'll kind of keep prices from going crazy for the rest of our. And the data centers say, well, we can't do that, right? You can't just shut us down on short notice, and so they need consistent power, and natural gas is really kind of the most obvious way to get that done. And so yeah, if as I say, production of these fuels is potentially peaking in the U.S. At the same time, demand is surging, right? You couldn't dream up a more bullish case for the fundamentals for a lot of these companies.
Okay. There might be some societal issues to work through, but as an investor, the imbalance really works to your favor. It's kind of interesting that nuclear, which personally I'm a huge fan of, that's the horse that bolted out of the barn immediately on this. But of course, that's the one that's not going to be realized for a decade plus, whereas the more immediate stuff hasn't really moved that much.
I mean, it's actually, terrifically ironic, right? You have Plug Power, which is a stock that I've watched for 30 years now, or, maybe not that long, but it was a high flyer during the dot-com bubble because everybody thought, hydrogen power, we're gonna need all this hydrogen power, and boom and bust. In 2021, same thing. Plug Power went to the moon. Stock price is down 99%. In the last few months, Plug Power started to take off again. Because okay, well maybe we'll need tons of hydrogen power, to kind of make up the difference in a lot of this demand that we need. And yeah, it's just ironic that you get all these alternative things when you have abundant natural gas here in the United States that is the most consistent and easily to deliver to meet these needs. But investors haven't quite come around to that way of thinking just yet. But as Jim Grant likes to say, right, successful investing is about having people who agree with you later, right? I want people to like my gold thesis later. I want people to like my energy thesis later. Right now, it gives me an opportunity when people don't like it to buy it at unreasonably low levels.
Okay. All right. Well, all right, folks. Hopefully, we've given you a lot of really interesting, compelling investment opportunities to go consider here. That being said, I want to get back to the AI part of the discussion as well as the cost of living part. All right, Jesse. So if things go the way you think they're going to, I'm resisting asking the question as how bad could it get? But maybe, what do you think is more likely than not to happen as this, whatever reckoning needs to happen here materializes? And let me just note one or two things from stats I pulled off your blog. I guess I'll mention this one. Um, uh, Julian Guerin argues that according to one economic model, the AI bubble is 17 times the size of the dot-com bubble.
Yeah.
Now, obviously, the economy is bigger than it was during the dot-com days, but it's not 17 times bigger by any stretch. So obviously, some sort of material correction in that AI bubble would have seismic effects, I imagine, on the economy and certainly the financial markets.
Yeah, it's right. Like I said, I'm not an economist, way above my pay grade to try and forecast the economy. I will say that one of the interesting things about the dot-com bubble was NASDAQ went down, 90%, and we had a relatively, painless recession relative kind of like to the great financial crisis, right?
Right.
Which
Unless
was
you worked in Silicon Valley, yes.
yeah, it was a much more painful for the broader economy. It was much more painful in 2008, 9, 10 than it was in 2001, 2 for most people. And that was because there was kind of a transition, right? We transitioned from kind of the tech bubble into something else. And Alan Greenspan blew a housing bubble to try and ameliorate the damage from the tech bubble bursting. But there was also transition from where what happened in the early 2000s. Energy stocks started to do really, really well. Precious metal stocks started to do really, really well. Small caps and value stocks started to do really, really well. And so there was this rotation. And behind that was a peak in the dollar, right? The dollar went through an incredible surge through the late 90s into the early 2000s, peaked, rolled over, and went into a 10-year bear market in the early 2000s. And with that coincided with a lost decade in the stock market, decade plus. I think we're at a very similar time now where the dollar has had a great run until very recently, until this year. It's had a 10-year plus, bull market. It's potentially, already peaked and rolling over into a longer term bear market driven by fundamentals, right? The dollar is dramatically overvalued. This is a lot of what, Donald Trump wants to try and address, is the undervalued, especially Asian currencies against the dollar. So I do believe that we're in a early year or two of a longer term bear market in the dollar. And that will precipitate a rotation out of financial assets. And part of that will be potentially a bursting of the AI bubble, but also, will be, have to force investors to invest in things. Well, what does well when the dollar's declining? Well, it's not stocks and bonds, it's real assets, it's gold, it's these types of things. That's another message that gold is sending right now, is officially the dollar bull market is over, and we're now entering a different phase, a different type of cycle. And so I think that dollar, bear market means that we're probably going to see a rotation towards, the old economy, value stocks, these types of things that did well in that period from 2001 to till 2008, 9, 10, 11, when the precious metals peaked. And so so from an investing standpoint, I think the key is, I don't really know what the economy is going to do, but because there's too many wild cards, right? The AI thing could be disinflationary, but the Fed could print money, and we could see fiscal dominance and all kinds of different things. But a lot of those things all point to one investment thesis, and that is own things that do well when the dollar's in a long-term bear market. And that is, these types of commodities and real assets. So I think that's the shift that's ahead, and that's the best way I can think of to kind of prepare yourself for however this, the AI bubble, plays out.
Okay. That's all very helpful. Let me transition to, let me put it this way. Is it safe to say that if there is a material repricing in the AI space, in other words, the folks begin to realize that, what, we're not going to realize any of this, or we're not going to realize nearly as much of this value on the timeline that markets are currently pricing in, that, folks start believing the Sam Altmans of the world and say, you know what, I gotta discount this stuff, right? So
Yeah.
if there's, pick a number, 25%, 30%, 40% repricing in those stocks, it's probably there's gonna be a tremendous negative wealth effect from that, simply because those make up so much of a huge percent of the current market caps, right? You're nodding as I'm saying this. All
Yeah.
right, so if that were to happen, no guarantees. If it were, we would expect that. That would hurt the affluent part of society that's really kind of keeping everything looking fine right now. You know, the averages look fine, consumer spending and all that type of stuff. But as we know, it's largely coming from that sort of top 10%, maybe top 20%. Everybody else is feeling increasingly pinched, which we're going to talk about in just a second. But those folks are going to feel it because they've been riding the asset price inflation that has been, you know, turbocharged with all the first monetary and then fiscal stimulus coming out of COVID. The fiscal spigots are still running strong. So, you know, they're the ones who are going to really take that, and that's probably going to crimp their spending, right? And so that'll have an impact on the economy. How much, we don't know. Everybody else won't be injured that way, but they will be injured to the extent that a slower economy means layoffs, right? But maybe that might bring the wealth gap a little bit closer in the end. And even though no one's going to be feeling great, maybe that's the silver lining there. Whether or not that happens, let's flip to the other side of the coin here, which is if you don't have assets, all you really have is the increased cost of living, and that only gets worsened the more the dollar weakens from here,
Yeah.
right? How concerned are you about that? You had a whole bunch of charts. I don't necessarily need to bring them up here to make this point. But that, you know, the bottom, I'm going to say 80% is getting increasingly left behind, disadvantaged. We're seeing, you know, all sorts of things like, you know, Google searches for consumers under distress, right?
Right.
You know,
Yeah.
and you know, I have no idea what kind of a timing mechanism that is, but it's certainly showing that people are increasingly feeling like it's hard to make ends meet. And the kind of the key kicker in the article that you wrote about this topic, you quoted Peter Atwater, and he's the one who coined the term the K-shaped economy. And he basically says it's not hard to see, if left unaddressed, the feelings that accompany extreme economic inequality can foster revolution.
Yeah.
And this is, you know, Peter talks about the 4 Fs. And I forget all of them, but the last one is F it, right? It's just when
Right.
people just kind of throw it, they're like, look, you know, anything that was restraining me before is gone, you know,
Yeah.
all bets are off now, right? And of course, history shows moments when the populace does that out of frustration, usually very bad things tend to ensue next. So
Right.
what are your thoughts about kind of the trajectory here of this underclass of, say, the bottom 80%? And do you see this trajectory changing in any way that prevents us from getting to an effort moment like that?
Yeah, you know, I think I love Peter's work. I think it's just, yeah, he coined the term the K-shaped economy, and I really should have brought that up at the outset, because as you point out, it's not just the AI capex bubble that's holding up the economy. It's the wealth effect. You know, it's driven by those AI stock prices that are making the wealthy feel even wealthier, and they
Yep.
can go spend, and so it's holding up spending, consumer spending to a degree too. So it's having an even bigger impact than we'd like, and the fact that you know, the economy is probably more dependent on that wealth effect than it has ever been before is absolutely you know, very concerning. And so I think that, yeah, that it's very important to kind of keep that in mind, that yeah, the lower shape of the lower half of the K, essentially all the consumers that don't own assets, are really struggling. You know, this kind of brings to mind too that this, you know, when Warren Buffett first introduced his Buffett indicator back in 1999, 2000, he highlighted the fact that corporate profit margins at the time were elevated. And he said that cannot persist for very long without creating political problems, right?
Mm-hmm.
The lower half of the K is not going to accept the labor share, essentially a smaller share of the economic pie for very long before people get pissed off and rebel against the status quo. So when you look at a lot of these things that are going on in the economy right now, one of the other things that's holding up the economy is this massive fiscal deficit, right? We've never run a fiscal deficit essentially this large outside of recession. And so we're running
and outside of wartime. Yeah.
Yeah, we're running this massive fiscal deficit when the economy is still growing. Like, what the heck is going on? That huge deficit manifests in corporate profits, right? And so I think people, will start, how do you fix a lot of these things? Well, they all kind of point back to the same thing. They point back to fiscal, right? The debt markets are starting to worry about fiscal. We have the lower half of the K is starting to get pissed off that all this fiscal stimulus is manifesting in corporate profits. They don't know it. They don't think about it that way, but that's how it works. And so how do you fix this? Well, you got to fix fiscal. And what does fixing fiscal look like? It means dramatic spending cuts, raising taxes on the wealthy. Combination of those two things is really the only way you fix it. That, is a huge bullseye on corporate profits, corporate profitability, right? You cannot fix fiscal without jiggering that slice of the pie. And which means more is going to go to the lower half because corporate profits are going to come down. And so I think, we're kind of coming back to, full circle to a lot of these things that we were talking about. So that's down the road somewhere. I don't know what it's going to take to get there. It could take a crisis in the bond market before something like that happens. But the people who are looking at price earnings ratios today and saying, 25, 26 times earnings, maybe it's not that bad. When you look at it, yes, it's at the highest, essentially range it's ever been. And it's built on record profit margins. You're assuming those record profit margins are sustainable indefinitely into the future. That assumes that the lower half of the K is never going to get upset enough to say, no, this needs to be rebalanced. We need to do so. A lot of these things kind of point back to the same thing. If you do get some type of a rebellion, I mean, we're not talking about like, physical violence, but it could just be a political.
Right. It could be a President Mandami. Right.
People vote for a redistribution, right? In some respect, that is a huge bullseye, as I said, on corporate profits. So, that's likely coming down the road. Is there's going to be redistribution somehow. And the longer it goes on, that the lower half of the K suffers with inflation and they don't benefit from assets, the greater that risk becomes. And that's probably something that most people aren't paying enough attention to.
I think more and more people are, especially those on the bottom half of the K, or as I've been saying, and I have traded DMs with Peter on this. I've said we're at risk of the K-shaped economy metastasizing into a lowercase I-shaped economy, where you have a dot at the top that's the affluent few who are doing fantastic, and then everybody else is the stick of the eye, just getting left increasingly behind.
Yeah.
And I don't know if we, if the political revolution comes before we fully get to that lowercase I or not, but I feel like the closer we get to it, the higher the probability for, some type of increasingly disruptive, social pushback becomes.
Yeah. Yeah. And there's been so much great work written about, the fourth turning and things about, how these things go in cycles. Ray Dalio's written about it, mostly from an economic standpoint, how, you get the 80-year debt cycle. And at the end of that, you get, we're seeing a lot of what happens at the end of a major debt cycle, at the end of a long-term, at the end of a fourth turning. And so, yeah, these are risks that are not being reflected in markets, at least.
Okay. I've got a final question for you on that, but let me wrap things up here first, because we're at the end of the hour. And Jesse, thank you. It's always so fun and fascinating and talking to you, and today has been absolutely no exception. Key question. So for folks that would like to follow you and your work in between now and the next time you come on this channel, where should they go?
So the FelderReport.com is my website. I put up, as you mentioned, a free blog post there once a week highlighting usually 5 of the most interesting things that I found during the week. So a lot of the time that's an article like, Peter Atwater's. It's a chart or two. It could be an interview. But a lot of it is kind of, that's, based on the research that I do to kind of track a lot of these narratives and themes that I write about, for the rest of my subscribers. I have a premium and a pro product too, where I actually highlight trade ideas and a lot of these macro themes in much more depth. So yeah, thefelderreport.com is my website, and there's a number of resources there to take a look at.
All right, and it is an excellent resource. Jesse, when I edit this, I will put up the link there on the screen. Last question for you, Jesse. You just talked about sort of this knife's edge, I guess, that we're sort of walking as a society here of trying to keep the party going, where we have a lot of sustainability concerns about that. Just again on what's driving society, the AI side and all that type of stuff that we talked about. On the other side is the fact that the more we succeed at pushing the status quo, the more of the population we push into the dispossessed side of things, and that has its own flashpoint at some point in the future. For the people who are watching this video, part of this channel is to just give them a sense of exactly what's going on here, good, bad, and ugly, but to hopefully make sure that they, no matter how this unfolds in the future, they end up on the best side of that possible. So any parting bits of advice for that person that is wrestling with these, maybe more short-term market things that we've talked about, these more longer-term macro things that we've talked about, but how would you kind of counsel them to try to survive as best they can at this moment in history?
I think that there's been, from a big picture level, there's been a long-term bear market in diversification, right? The less diversified you've been in recent years, the better you've done. And that's encouraged people to, go from, okay, I'm going to have an asset allocation model to, okay, I'm going to have a 60-40. Okay, now I'm just going to have stocks. Okay, now I'm just going to have the S&P 500. Okay, now I'm just going to buy the Magnificent Seven. Okay, now I'm just going to buy the triple levered NVIDIA ETF. And get narrow the diversification down, right? I think we're going to, we're on the cusp of a bull market in diversification, where it's going to make a lot of sense to own a lot of different things and not be overexposed to any one theme, any one area of the market, any one asset class. And so what that looks like is, okay, if you want to still own some equities and you still want to play the upside there, fine, own some other things too that are going to protect you if the AI bubble bursts. We mentioned a ton of them during this last hour. But I would just say diversification. Own uncorrelated things. Gold is sending a message in that right now. Like, look, you don't have to own these, be 100% in AI stocks to do well in the markets. And that message is going to be reinforced, I think, by a number of different asset classes globally over the years ahead.
All right, great answer. I'm going to squeak in one last question here, even though I said I wouldn't. With gold has had a phenomenal year. It is probably it's the messenger of an important message, as you've said here, in terms about the dollar. Gold could very well have a pullback here, given how far and fast it has moved. Beyond just the short term, do you think the message that gold is telling is over, or are you still relatively optimistic about the longer term outlook for gold? And by longer term, let's say the next 1 to 4 years.
Yeah, no, I'm still optimistic. I'm not as heavily overweight gold as I was. And that's just largely due to, as I said, that oil to gold ratio and other indicators that suggest there's better value in other areas. But I don't want to be out of gold. I don't think we're near a longer term peak just yet. You don't have all the signs in place yet that suggest that retail has jumped on board. I mean, you go to CNBC and they don't even have one story on the gold price. So you do see them in other places in the Financial Times and whatnot, but I don't think we've seen the signs of that you'd see at a 2000 2011 type, early 80s bull market high in the precious metals. We'll probably get there before it's all said and done. So, I want to own some, but I think there's better value in other areas.
All right. Thank you so much. Really appreciate it. Sorry for slipping that last question in there, but it occurred to me that there are a lot of people, including myself, who wanted to hear your answer to it.
Sure.
But anyways, Jesse, been fantastic as always. Thanks so much for coming on. Look forward to having you back on soon.
Always great to talk with you, Adam. Thanks. Appreciate it.
All right. Well, now's the time in the program we bring in the lead partners from New Harbor Financial. I'm joined today by Mike Preston. We're recording this a day after I recorded with Jesse, as you can tell by my different shirt. John Loder has the week off. Mike, how you doing?
Really good, Adam. Thank you. Good to see you.
Good to see you too, buddy. All right. Well, thanks for going solo this week. So Jesse, one of the just such guys who's such a joy to interview because he's so smart, he's so articulate, he lays it out in a way that I think just the regular person can understand. As he was talking, I was thinking, all right, I think New Harbor is going to have a lot of agreement with Jesse here. What were some of your key takeaways from the conversation?
You really just started at the beginning of the talk. The question you always ask about the outlook on the economy and the markets. Jesse said this is one of the most precarious times for markets, really characterized by a couple different things. He talked about stagflation. He talked about the AI bubble. That's a big hot topic right now. We'll talk a little bit about that later. And he said that multiple warning signs, late cycle indicators are starting to suggest that we're approaching a market reversal. And in that camp, I would put things like, rising unemployment rates is, it's definitely a lagging indicator, but it's something to think about. I know that other people, including, I believe your guest last week, said that unemployment is actually bullish for the market, particularly mid caps. So,
Right, Mike Kantrowitz. Yeah.
Mike Kantrowitz said that. So take that one with a grain of salt. But other late cycle indicators that you might expect are things like this: obscene valuations. It's been that way for years. I completely agree. But also a thinning of the market. We're still driven by the top 7 or even top 3 stocks here. Our internal indicators are showing a narrow market. Now, that's not having us go to cash or short the market or run for the hills. We're still 45% on equities. But I have to say, we're in this market really kind of holding our nose, so to speak, with all of the other things that we're seeing in terms of valuations and narrowing of the market. We're thinking that maybe we get a blow off top here and the market broadens, but we don't see any of those signs yet. In fact, on Tuesday, we had our long portfolio meeting. We looked at all the indicators again, and really we're tilted towards defense here, towards the bearish side. And we're not seeing big breakouts yet, even though the market has been relentless, absolutely relentless, going up almost every day and staying well above the 21-day moving average for many weeks here. So it really seems like we're ripe for a breather in the S&P and ripe for a breather in metals markets. We can dive into some charts later. But I've learned not to anticipate markets. We anticipate markets maybe but just by being lower in equity allocation. That's how we handle the fact that none of this really makes sense at these levels fundamentally, and the data doesn't make sense. But as far as the actual exact turn, it's impossible to know. So all you can do is have a plan in place, sometimes some hedges in place based on where we're at in the cycle, and then react to what actually happens. If we're lucky enough to get what we think might be coming, which is a squeeze, a vertical parabolic move higher, that'll be ideal because then we'll be able to reduce equity exposure into that ramp and then hopefully not give back much of anything on the ultimate turn that we think is coming. So if I could just make a couple more points about the video, I think that I'd just like to recap the rest and then maybe pause after that. The credit market is starting to deteriorate a little bit. There's been some recent bankruptcies. I think that Tricolor and First Brands were mentioned. And private equity firms like KKR and Ares and others, stock prices have been not tanking, but they've been trending downwards when the S&P has been going up, and there's been a lot of insider selling there. So these are all just anecdotal data points in and of themselves don't mean a lot, but these are just storm clouds gathering type things. Insider selling across all S&P companies, as Felder said, was the highest over the last 2 years. And volatility too. This is something that I didn't pick out until he said it. It's pretty interesting. The S&P over the last week up 1%, VIX up 8%, right? So Usually when VIX goes up, the market goes down. It can also mean that there's some other volatility coming, and it could even mean a crash up. So who knows? And we can't really, I don't think we can anticipate there either, but we can say that the market is sensing some type of stress. And then, he talks a little bit, or you mentioned a person who said that the AI bubble is 17 times bigger than the dot-com bubble. I've got some charts that can talk about that if we want to dive into that. I don't think we need to quite yet, but the AI bubble is huge. That technology is real. I'm using AI. It probably saves me many hours per week. So if you multiply that across 300 million or 200 and something million working people in the country, you got to imagine that that actually means something, right? But does it really justify where we are with the AI bubble? Probably not. So just in wrapping up here, a couple other things, and you can tell me what you want to dive into out of these things. He talked about what to own: commodities, energy, gold, natural gas. He thought we were in a dollar bear market. We actually disagree near term, like between now and 2 years from now. We think that we're actually going to see a dollar bull market. And he talked about after years of concentration paying off and just going all in, diversification matters here. So we would agree with that as very much. Don't go all in on anything. Don't go all in long the market. Don't go all in short the market. Don't go all in on silver or gold. It's really hard. I mean, a lot of times these days we're talking to people that are all in on gold, silver, or miners, and it's hard to get them to start moving out. Even then, even though we're believers in those markets, we really think people should start selling and open up their mental flexibility. So thanks for the opportunity to recap, Adam. I'll hand it back to you.
All right. So I want to pull up some articles here on the front page of Yahoo Finance the day that we're recording this, Mike. So first is, Yahoo Finance it's mainstream financial media, right? And the main story title here is very speculative, very frothy. Wall Street frets on risks to rally. Stocks are near records, but sentiment gauges show growing euphoria, a potential warning sign. So, the market has been in just massive party mode. S&P, you can see here on the chart, it's 6,750 as of the time of this recording. 7,000 is not that far away at this point in time, right? And that creates a very strong psychological pull towards that big round number. But the fact that you're starting to see some questions being raised in the traditional mainstream financial media, which has been doing nothing but cheering on this great third year in a row that we're having in the markets, that's an interesting sign to me. That even the cheerleaders are saying, "Whoa, maybe the party is getting a little bit too out of control here." I want you to respond to that, but before you do, just because we'll go to this, I'm sure soon after, I want to highlight this article here about gold, where it says, "Quote, debasement trade continues as gold soars to new heights." And I put out a tweet on X this morning saying, "Oh, okay, I guess we know the answer now. It takes 4,000 an ounce gold before the traditional financial media wakes up to the fact that fiat currencies may actually be being debased by government policy." So there's this new term that they're now coining for gold here, which is the debasement trade, and I'm sure Bitcoin would be under that same trade as well. So that's interesting to me as well, that the traditional financial media that generally ignores gold certainly doesn't seem to give any ink to the loss of purchasing power of our fiat currencies, is now kind of waking up to it and calling it the debasement trade. So anyways, Mike, I'd love to get your reaction to both of those.
Well, the first one says very speculative, very frothy. Wall Street frets. Well, I think that probably a cynic would say something like, well, markets always climb a wall of worry. So that's actually a bullish sign. Or a contrarian would say that, I guess, is probably more accurately put. But we are not in a normal market. We're in a hyper overvalued market near the end of what I think is this money printing era, and in the last 5 years of a fourth turning. So we're in an all-in moment. And yeah, talking about the debasement trade, absolutely. I think it is different in terms of this bull market in gold. We have just exceeded the 1980 top in inflation adjusted terms in gold price. And you know how generals always fight the last war, and even we have to think about our own biases, right? It's because the last time in 2011 we had a big bull market, everyone was all in. There was gold buying parties that people had in their homes. There was all kinds of advertising for buying back gold. That ended up being the top, and there was a minus 40% bear market, and it took over 10 years to come back to even. And so none of us wants to go through that again. But I think that where we are in the cycle here makes it different, and unlikely to collapse again after, like it did after the 1980s top and after the 2011 top. Having said that, the short termness of all of this is getting really, really hot. It's getting hot in here with this trade. And so you should be expecting some near term rapid reversals to shake people out. I wouldn't say it would necessarily be the top, but really, if you're too long here and you're too over concentrated, you got to think about your own emotions and your own greed factor at this point. So yeah, I think that the debasement trade is real. For those that doubt it, I think there's probably a number of years left in that whole trade. But don't be afraid to rebalance a little bit here and there. Think about maybe 10% of your investment assets, gold, precious metals, and crypto altogether. Because we really view those as all the same thing. Non-dollar, gold, silver, miner, crypto, sleeve. We would put all of those things and do put all of those things into one category in our own systems and our own thinking. So you got two headlines there. One, I think, is real, the debasement trade. The other one, the skeptic kind of putting the red flag or the yellow flag out there. Yeah, I think that we could have a big pullback at any time. But I don't think at this point we're going to end this cycle without some type of euphoric move. I can just feel the pressure building, and maybe that's why the VIX is up while the market's up. Maybe it's signaling a parabolic move higher. That would be welcome again in a way because it would signal to us that we're getting close to the turn. So most normal people don't have to worry about this that much. When I say normal people, everyday people, because even if we do go to 7,000, and I think we will, by the way, that's only about 3% above here. The charts look like we should get to at least 7,500. What is that? 800 points above here? That's like.
But that's what I was going to ask. If this thing sort of has the blow off top that you think it might, what are you thinking? Is it 7,500? Is it 8,000? Is it 10,000? Like what?
Just realized that there's some gut feel in my response here through, I guess, which is almost 30 years experience now, and having been through the other bubbles. What I'm looking for is like 500 points or more up in a short period of time, say 2 weeks. So that would be like 8% into a couple weeks. So that would be the signal that we're getting real close. So if that happened, it would bring us up from here to about 7,300. You got to think you'd go a little higher than there. So 75-ish, 7,500 or so could be a target. But who knows? We're at the end of such a big cycle, it could go on. I don't think for the average person it makes sense to hold on for the last few percent. As we keep saying, we're at 45%, and that's probably our max, no matter what happens here on the upside, because we've got exposure in some other things that are doing really well. But yeah, look for that. Look for if we're lucky enough to get that, it'll be a rapid squeeze higher, 500 points or more on the S&P in a short period of time.
Okay, and you would expect if you saw that would be a peak. Look, there are no guarantees, folks. So I got to caveat all this. But would you think of that as sort of a peak like we saw, putting in a peak like we saw at the peak of the dot-com bubble, or the peak at some of these other historical bubbles we've seen, meaning dramatic shoot up but then followed by a pretty painful percentage correction?
Yes, I think that I think the fourth turning is a real theory that has real use here, and I really believe that all of the signposts say that we're in that, and we're in the final 5 years. I think the crisis part of it, which is the second to last step of a fourth turning, will be kicked off by a market drop, and then the climax, which is the final part of the fourth turning, comes a couple years later. Between the crisis and the climax is potentially a minus 60%, minus 2/3 on the stock market. And unlike other times where the tech bubble was reinflated by Bernanke/Greenspan, and the housing bubble, which was reinflated by, I guess it was Bernanke, Yellen, Powell, etc. That's not going to be able to happen again because what I'm thinking is going to happen is a loss of confidence in this central banking shenanigans, right? So this peak, I think we go down 2/3 or more, and it stays there for more than 10 years. That's what I think,
Wow. Okay. So
which is
down
a
there, meaning sort of like a lost, when a painful correction, but then a potential lost decade in terms of returns.
or two, it could last 10 or 20 years. So just think about that. I mean, and John Hussman is potentially right. He talks about it a lot in his writings, and we've mentioned his name here a lot of times because we have a lot of respect for him. I remember many years ago, he wrote a piece called, We're Going Nowhere in an Interesting Way, potentially. He too doesn't make exact predictions, but we could lose 2/3 in the market and then take 10 years clawing back to even.
Got it. And again, just to make sure folks know, if that were to happen, and of course, lots of unknowns here, Mike's sort of talking about measuring from the beginning of the decade to the end of the decade. Doesn't mean that things couldn't go up and down a lot in the interim. And the point there being is if that's the case, then that's where an active investing strategy is going to be much, much more superior than a passive one. And of course, we have trained the past 20 plus years of investors that passive is the way to go. So it's going to be really interesting, should that happen, to see how everybody is basically going to have to throw their current playbook out the window and adopt a new one.
Yeah, it's very generational. It's a big cycle, and this is just unlike other times in the last, I guess, 80 years. Fourth turnings come around every 80 years, but close to 80 to 100 years, we haven't seen a cycle as dangerous as this one. It's no surprise that the buy and hold crowd is more emboldened and more all in than they've ever been before. That's what happens in a bubble. I've certainly learned in my lifetime and in my career that calling the very top of any market is near impossible. So I've certainly made the mistakes along the way, learned a lot, um, and I'm still admitting today that there's some guesswork because nobody knows the future,
Right. Well,
But
and it's when the party is raging, those who, the old Hussman again, bubble markets force you to make a choice, look like an idiot now or look like an idiot later, right? And those that don't want to look like an idiot later, meaning you're the collateral damage once the bubble bursts, they get out early, right? And there's a lot of wisdom to that, right? To sidestepping all the carnage. But to your point, Mike, nobody really knows the timing, right? There were lots of worry signs in like 97 that the market was, I think Greenspan's irrational exuberance was back in 96 or 97, right?
96.
Yeah. So if you hopped out then, because, oh my gosh, the chair of the Federal Reserve is saying that the markets are too euphoric, right? I mean, there was then 4 more years of unbelievable returns that you missed out on, right? So you have to weigh the probability. So to your position there at New Harbor, Mike, where you're managing client capital and you've got these concerns about what could happen, you still are in the game to a certain extent, right?
Well, we have to be really. I mean, there are alternatives. Okay, we'll say that straight out. 1 year T-bills, Treasury bills are still around 4%. We've got 20+% in there. So, for a lot of your viewers, I think, are 100% in the T-bill and chill trade. I can't criticize that. And at this point, I would just stay there and wait for the crash. But yeah, we are in as active managers. We're 45% in. We have some hedges. We sold a lot of covered calls this week on some of our positions. We sold calls on the other day. We sold calls on utilities. We sold calls on international stock ETF as well because we think the market will likely keep going higher, but we don't know when we're going to get a rapid reversal. And we want to be able to reduce that risk, bring income into the account. And options give us a really neat way, a really cool way to start selling hedges into a decline. So when the ultimate reversal comes, we can hopefully really defray that deductible on the turn. And if it keeps going higher, we can participate. And we're happy to not be 100% in. I mean, if this market went up 50% from here, it would be almost S&P 10,000, I guess, because we're at 6,800. And we would definitely underperform at 45% because we're probably not going to get more in as it goes higher, but we still have to be okay with our decisions. And we would be then looking for the ultimate turn. And that ultimate turn, if I'm right, about a half or a 2/3 decline would bring us well below where we are today. That's what happens when you mess with financial markets. They get dangerous, generationally dangerous. And that's what central banks have done. I think they won the game. Many times to me, it feels like they've won the game because they've controlled every minutia of the market and economy for all this time and got away with it, right? And all the bankers from back in 2008, they got away with it. Nobody went to jail. Everything's smiles and, peaches and cream. And the 401ks are up and the real estate markets are up and everything's up, 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 up. And it has to be, because if it's not, then the whole debt pile falls apart. But there's a price to be, there's a price that's coming. We're trying to play the game. I'm not saying that we can be perfect and we can time it perfect, but we're doing it the best that we know how, given our experience.
Okay. And I think the key part underscoring what you're saying, Mike, is you're doing what you're doing to try to get the maximum. You're trying to find the efficient frontier of getting prudent gains while having prudent risk management in place, right?
That's right.
So what's interesting is, so just wrapping things up here, there are lots of reasons to be concerned, as Jesse shared with us, and you've just reinforced. What's interesting is I'm starting to see an increasing number of the experts that I mentioned here. They're still a minority, but they're beginning to say, I'm actually beginning to become a little bit more optimistic about what's coming ahead, right? And that's folks like Kantrowitz and Anna Wong, and I just interviewed Ed Yardeni, who's generally been a bull for a good while, but he's quite optimistic about where things are headed too. So, there is this sense of people that are saying, hey, look, I think this party's got a long ways to go still. And of course, this is what makes a market, right? And I'm not here to tell folks which way is the exact right way, because nobody knows. But what you want to do is take in a ton of information, listen to a lot of these experts, and figure out, whose arguments you find the most persuading, and then place your bets accordingly. But I think the important thing to do, no matter what side you pick, the bullish or the bearish side, is that you are trying to find that efficient frontier of prudent returns versus risk management, right? And so as an individual, if you're a DIY investor, that's really what I think your priority should be. And if you don't feel like that's something you got a lot of experience with or a lot of confidence in doing yourself, that's why I think you should be working with a good financial advisor, and one that really understands trying to find that optimal balance. All right, Mike. Well, so basically, folks, if they want to, they can obviously reach out to talk to you and your firm there at New Harbor during, in one of those free consultations I mentioned on this channel all the time, and say, hey, look, this is how I feel. I'm more bullish, more bearish, and you can obviously help them figure out how to craft a portfolio strategy to support that, right, Mike?
Absolutely. We offer a free consultation to anyone that wants to reach out. We're blessed to have that opportunity, thanks to you and your audience. We have so many great conversations with really good people out there. Please do go to thoughtfulmoney.com and fill out the form and reach out to us.
You're doing my work for me. Thank you, buddy. Yeah.
And we would be happy to have a brief 30-minute conversation. It's all about giving good advice.
All right. Well, thank you. And folks, if you feel so inclined, definitely go ahead and do that. But the other reason as well that folks should maybe consider talking to a financial advisor right now, Mike, is just seasonality, right? So we're getting to that time of the year where there are steps that if you're going to take them, you want to take them before the end of the calendar year, because you can't take them after that, right? Some of this is tax loss selling. Some of this is related to retirement accounts, distributions, and things like that. So that is correct, right? I mean, there's regardless whether you're bullish or you're bearish, there's oftentimes just times of the year where you have to just look at your personal situation and say, okay, what housekeeping do I need to do before these end of the year limitations come up, right?
Yeah, right now we're coming up on October 15th. This video will be out well before then. October 15th is crunch time for tax preparers, because this is the final tax filing deadline for those on extensions. And so we're getting some calls from people like that, particularly with self-employed retirement plans. I know that my partner John mentioned this in previous weeks. You have up until tax filing time plus extensions. This is for self-employment retirement plans. You can make contributions up until that point. So there's a little bit of a mini crunch going on here about that. But as we go into the end of the year, the final 2 months, it's really all about charitable giving, gifting to children. And I think we're up to 19,000 this year. I have to double check that, but I think the gift tax exemption is 19,000 this year now.
Right. And that's per parent, right?
Per parent, per child. So if you're a married couple, you can give 38,000 away to each child without filing any tax documentation. And if that child is married, then I guess it goes up to 78,000 because it could be to each of those, the children plus the spouse. So a lot of people have bigger and bigger estates. The exclusion is way up there in the teens on the 13, or it might have just jumped to actually 16 million here recently. And I can't actually remember because things change so quickly, but
You
it's
talking about estate tax?
the estate tax exemption. I think might be up to 16 if I remember, but it's at least 13. We don't really run into it that often with clients, but it's way up there. So people don't have to think about it that much. Generally, some people do, and they should be using this gifting strategy to get down below that limit. But just a gifting strategy in general makes sense if you want to help out your children during your own lifetime and see the fruits of your cash working in their life now. It's something that we tell a lot of people to do. So gifting, charitable giving between now and the end of the year, both of those, and then gain and loss projections. It's been a really good year for just about anybody in the market. It's been a really good year for us at New Harbor. We're well up into the teens on average for our model in terms of gains. And so most people have either short and or long-term capital gains. If you have any losers in the portfolio, which hopefully you don't, but if you do, you really should be going through there and farming through and taking those losses to help reduce your tax burden before year end.
Okay. All right. Well, look, we'll leave it at that. So yeah, folks, if you've got any of those things that Mike just dialed through that you'd like to get some help with, again, highly recommend you reach out and talk to a good professional financial advisor. And if you've got one who's doing that well for you, great. Don't mess with success. But if you don't, you're like a second opinion from another firm that's experienced in these issues, then consider talking to one of the financial advisors that Thoughtful Money endorses. Perhaps you'd like to talk to Mike and his team there at New Harbor Financial. So again, to set those up, just fill out the very short form at thoughtfulmoney.com. And again, these are totally free. There's no commitments involved. They're just going to do what they can do to be as helpful as possible to you. All right, folks. And again, we are getting real close now to Thoughtful Money's Fall Online Conference that's coming up a week from this coming Saturday. It's going to be Saturday, October 18th. If you can't watch live, don't worry. Everybody who buys a ticket will get sent replay videos of the entire event, all the presentations, all the live Q&A. I can tell you it is coming along fantastic right now. I just had an experience planning for it that I'll talk about later after the conference, and you'll understand why. But just a phenomenal personal moment for me with one of the great faculty members we have. And again, I know I say this every year, but this is the best, most august faculty we've ever assembled. And I think it could not be more timely given all the cross currents and all the uncertainty that's swirling out there right now as we head into 2026. So if you haven't bought your ticket yet, run, don't walk to thoughtfulmoney.com/conference and buy it there. It is still available for the next couple of days at the last chance to save price. You missed the lowest early bird price discount, but there still is a bit of a discount before tickets go to full price in the final week. And I'd love for everybody to not have to pay full price. And of course, if you're a premium subscriber to our Substack, look for the code I've emailed you that gives you an additional $50 off of that ticket price. All right, Mike, can't thank you enough. Folks, please let Mike, you appreciate him going solo here this week by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Look forward to seeing you again next week, Mike. I think you're going to be solo again next week too, because John's going to be away for a couple of weeks. But no matter what happens in the market between now and then, we'll talk about it with you next week.
We'll be here solo next week, and we appreciate the opportunity to be here, Adam, and we appreciate your viewers tuning in as well. Until next week, we'll see you soon.
All right. Thanks so much, Mike. And everybody else, thanks so much for watching.